I promised you that we'd be talking about loans against mutual funds. This is something that we have discussed on this program, but there have been updated norms by the Reserve Bank of India when it comes to loans against securities. To talk about why you should use this, I'm joined by Sharad Tandon, who's the founder of Invest at Ease Private Limited. Sharad, thanks so much for taking the time. And the reason I wanted to talk to you about this is because I heard a conversation lately. In fact, somebody was even discussing it with me to say that you could consider using leverage when you want to invest, when you know for a fact that the market is at a certain level and you feel that the downside would be limited. But that's a high risk strategy. We established that at that moment as well. But I thought it's important to talk about from a prudent standpoint. Why would you use a loan against mutual fund? So first, what is this? What are the rules right now?
So Alex, pleasure to be on this program again with you. And it's a very dicey topic to cover. And I'm sure the person who was talking to you on the loans against share is a good means to raise capital to invest, probably enhance return, would be of a certain risk appetite, which is we can easily call up to like aggressive or very high aggressive portfolio, and probably with in the segment of HNI, ultra HNI. Now, as the name suggests, what is loans against securities? Now, when we talk about the securities, we also include mutual fund units in that as a category. Now, typically, and if you go by the product itself, RBI now allows up to 1 crore per person to borrow on it, up to 25 lakhs to invest into secondary market IPOs or buying units in secondary markets. Now, the segment we are typically cater to the channels is a retail segment. So they will not be that ultra HNI. They will be probably in the range where their portfolios are 25 lakhs to 5 crores sort of thing. Do they want to borrow 1 crores to enhance returns? Is a slightly risky bet. I will strictly say no. Why they should look at this product is predominantly for 2-3 reasons. One is I don't want to redeem my funds for next 2-3 months. I have appetite to hold it for long, but there is sudden emergency requirement for me, like which can be working capital for a small SME businessman, or say emergency corpus required in the family for any emergency which could have happened, or simply if my long-term capital gains have not kicked in, I want to hold it for certain 2-3 months more before I actually redeem to avoid the taxation or reduce the taxation. Avoid is a wrong word. For those 3-4 reasons, probably yes, it's a good option to do. Take a loan against share. Otherwise, to reinvest that money again in the market is a very, very high risk category. It's, for want of better word, akin to investing into microcap or a sectoral funds where volatility can tilt it either ways.
Okay, it's well put. Okay, let me ask you this then. Since it is something that is taken for emergencies, as you've suggested, I'm just trying to understand what existing loan product you would compare it to. It's not a mortgage, because mortgage goes into 15 plus years, oftentimes goes even beyond 20 years, but it has collateral. So would you compare it from that perspective with a personal loan? Is it better than a personal loan because the rates that you would get should technically be better?
So Alex, typically all the loans against shares are what we in a banking parlance call designed in the sense of overdraft facility. So what RBI mandates is up to in equity category 50 to 60%. 60 is a suggestion which RBI is considering. 50 is the current limit. On the debt side, around 75% if I get it right. And liquid funds up to 75 to 90, depending on the organization to organization, they can loan against the value of it. So which in a simple term means if I have a crore of worth of portfolio, in an equity portfolio, probably I'll get around 50 lakhs loan to value book. But in the debt, I can take it up to 75 to 80 lakhs. In a liquid, I can go up to 90 lakhs. Now, all these limits are sort of recalibrated every day end on their closing price. So suppose there is a limit where I've taken equity and market goes down. Or even better, if we take example of last 1 year, markets have not done very well. And if someone had taken, say, September 24 loan against shares product against overdraft, he's practically not made any returns on the markets while he's paying an interest. Now, interests are lower, as you rightly put, because they are collateral loans. So interests vary from organization to organization. Whether you're taking from banks and BFCs, it can vary from 7.5%, 8% to around 14, 15%. Personal loans will vary from 10 to 18%, 20%. If you go for a private loan, probably as high as 2%, 3% per month, which implies around anywhere between 24 to 36% per annum sort of loan on the unorganized segment of loan or a clean loan.
Understood.
Now,
Yeah, please
that's
go
where,
ahead.
yeah. So in light of this, unless until as an advisor, we are very sure, as an investor, we are very sure you are going to supersede or do, if your interest is X plus something by utilizing this way, probably yes, you can look into it, but avoidable, especially on the volatile market and equity assets.
Okay, but as an argument, let me suggest this, right? If you have a liquid fund and you don't want to withdraw that, and it's yielding you, or you have an arbitrage fund which is yielding you on an average about 50 basis points to a percentage point above your liquid fund. So anywhere between, at this moment, 6.5 to 7.5% per annum. Would it make sense to utilize this over a personal loan if you don't want to break that funding? I'm just talking about it because you have, suppose you're paying, and you're saying between 8 and 15% on such a loan. If you earn about 7.5%, then you're covering a large part of the cost of it, hypothetically.
Yes, you are right. But look at a scenario where, say, your liquid fund investment or short-term fund investment is closer to 23, 24 months of the investment cycle. Now, by taking that 1 month of loan at slightly higher cost, what you are doing is you are converting your short-term capital gains to long-term capital gains. Now, those sort of scenarios will play out with the individual person, but thumb rule wise, you are perfectly right to say it doesn't make sense to borrow against liquid fund or arbitrage fund and do this. It might well be a better bet to withdraw and take care of the requirement.
Okay, fair point. So you mentioned 1 month. Is it normal in this case? And Sharad, you also said this is like an overdraft facility. Is it normal for the tenure of these loans to be pretty short?
So generally, Alex, the limits when they are set up depending on 1 month to 36 months. If banks, then probably 1 to 24 months, and every year they will probably review it, how much has been utilized or not utilized and how much they are earning on it. But generally, the approval period is 1 to 36 months, and you can use it at any point of time. So advantage of this is, of course, one compared to personal. Personal loan processing will probably take 7 to 10 days. This is one time setup of 1 to 3 days, and you don't have to do anything. You can borrow for a day and you are being charged only for that 1 day of interest. While in personal loan, some organization might have a monthly reset or something of that, and you might end up paying more.
Okay. I want to ask about that margin call because I think a lot of people do understand this, but some people miss it out. So what are the rules that govern this? Suppose you have a sharp, over the course of a week, 4 to 5% drawdown in the equity market that causes your portfolio maybe to drop a little more than that. So 6 or 7% drawdown in your portfolio, and you've fallen below the limit. What happens then? What is a normal activity that takes place? The lender will probably give you a call and ask you to pay back a certain amount of money or provide more collateral. Is that how it works?
Yeah. So Alex, every day end the loan to value gets set. And if you are below the 50% threshold, say in case of equity lending, for 7 continuous days, the lender will ask you to either give you additional collateral to cover that differential, or you will have to pay off the loan to that extent so that your limit doesn't reach 50%. If you don't do that up to 30 days, then lenders have their in agreement to charge you a slightly higher rates, and they have to report to RBI also because as per the guidelines. So those are the pitfalls, and no one wants to get their credit rating slightly reduced because of all these nuances at the drop of a hat.
Sharad, so I think the crux of the conversation is that this is something that you should do only for emergencies, and even that you might want to selectively use it because if you have available funds, you might want to liquidate that and utilize it for those emergencies rather than borrow further money. But don't use it for things that could result in you losing your capital, which is like going for IPOs or certain other investments, unless you have the risk appetite for it, and very few people do. Sharad, thanks so much for taking the time for speaking to us on NDTV Profit.
Thanks a ton, Alex.
All right, that brings us to the end of this edition of Your Money Matters. Thanks so much for listening in. Do stay tuned. This is NDTV Profit.